All right, so welcome to Financial Accounting by Samuel Ibanda. We are here to look at partnerships and more so preparation of partnership accounts. So partnership is one of the forms of businesses that we have, just like the way we have limited liability companies, we have sole proprietorship, we have non-for-profit. Partnerships also come as a form of business entity. And here the keyword is partners. So more than one person come together and act as partners. They share profits as well as they share the risks in starting a business. So these are much common even with our accounting profession, because we know very well that for you to run an audit firm, you run it as a partnership. Audit firms are not run as companies. Audit firms in Uganda are required to run as partnerships. Now, partnerships are a little different from the corporate registered entities. Yes, you can run a company, one or two more people, but partnerships are usually governed by what we call a partnership deed. We even have the Partnership Act in Uganda that governs partnerships. So partnerships, you're more of like, it has characteristics of sole proprietorship. So you're more of, let's say, more of a sole proprietor, but now in this case, you're sharing the risks and rewards that come with partnership. Sometimes entities also go ahead to register the partnerships. And that is why you could see entities with the word LLP, so a limited liability partnership. So they can register the partnership as a limited liability. But for matters of our study, we want to look at it from the perspective of a partnership as it is. So like I said, partnerships are usually governed with what we call a partnership deed. Okay, they're usually governed with a partnership deed. And here, one of the things that we also understand is that the partners come together and combine their capital. So they combine their capital, they combine their expertise, they combine their skills to be able to set up a partnership. The partnership is usually governed by what we call a partnership agreement. Sometimes they call it a partnership deed. And basically, a partnership agreement lays down the terms and conditions in which the partners will be able to operate. And this could cascade into aspects of how they are going to share their profits, how they are going to contribute capital in terms of who contributes how much and who contributes the other. We go into aspects of who is going to earn a salary, how are we going to recruit other partners, what happens when this partnership ends, and so on. So all that is important to help have a smooth flow for the partners while they are running the partnership. So that is what basically the partnership agreement comes in to help us. So we know very well that just like I said, partners contribute capital. Just like the way any sole proprietor would contribute capital to their business. Even here we have what we call capital. Now, because the partners contribute capital, we have what we call interest on capital. Now, the partners can decide to pay themselves interest on capital. Now, the partners have given the partnership their money. Now, the partnership as an organization has to pay back in terms of interest to the partners for using that capital. And that's why we call it interest on capital. So interest on capital is a reward to the partners paid by the partnership. And when I say by the partnership, I mean now the organization. When it gets money from the partners as capital on a yearly basis, the partners can agree to pay themselves back an amount of money, which we call the interest on capital. As we can see, interest is a reward to capital. So that is very important. And then also one of the things that we also get to see is that when partners are together, sometimes we could have a partner who is very skilled and maybe has time on them, and they are going to be involved in the day-to-day running of the business. So for partners to be fair to each other, because some partners actually dormant partners. I know you might have heard about the different types of partners, active partners, dormant partners. So some partners may actually just contribute money and it ends there. So for us to create a balance to ensure that the partners that are involved in the day-to-day running of the business are able to take a reward home, then we have what we call the partners' salaries. So partners are remunerated for their being involved in the day-to-day of the business. So as part of the agreement, the partners have to agree who is to earn a salary, who is to not earn a salary, and by and how much, if the salary is actually existing. Now, the salary to the partnership, of course, just like the way the employees of the partnership may take money from the business in terms of payment of their salary. So that is very important. Now, one of the other things that also maybe I would also comment about is the aspect of drawings. So partners can also draw some money from the partnership or from the business. And just like the way we have sole proprietorships, where we have the aspect of drawings, where you take money for your personal use. So a partner can take money for personal use, even when it comes to partnership. So what happens in this case is that now we have the drawings, but also we usually have what we call the interest on drawings. We have the drawings, and then we also have interest on drawings. Now, when partners take money, we record that as drawings. Now, not to encourage partners to keep taking money from the partnership, partners can come up with what we call interest on drawings. Now, the interest on drawings is a charge on those partners that have taken drawings during the period. So that is also one of the things that we're going to see, and we're going to see how that comes into picture. Now, one of the other key things is here, like we've seen, that partners make decision on their profit sharing ratio. So just like any other entity, a partnership most at times are started to make profits. So after the partners have made profits at the end of the year, after removing expenses, what they remain with, the net profit that you would call it in a sole proprietor or a limited liability company, is shared among the different partners. Now, like we've said, the partnership did specifies on how the partners do share the profits. But in case they didn't specify that, then partners usually share equally, if at all it's not laid down in the partnership deed. But in most cases, they will actually lay down that they will be able to say, this is the amount of money. In case we make a profit, this is in terms of how we shall share profits. A case in example here, we have two partners. We have a partner called Bill and Ben, who are partners, and they share their profits in the ratio of 2:1. And then they also go ahead to agree to pay themselves a salary of 10,000 each. And then they're asking you, if profits before deducting salaries are 26,000, how much income would each of the partner receive? How much income would each of the partners receive? Now, we are going to look at how to prepare partnership accounts. And we have key accounts that we look at. We have the partner capital accounts, we have the current accounts. We also have cases where we have what we call the appropriation account. Now, right here, this is just a scenario to help you just appreciate how partners share their profits. As we can see, if there is a salary that each of the partners is taking, then we first remove it from the profits, because they are telling us profits before deducting salaries. So if these are usually the profit before appropriation. These are the normal profits that you'd have for a normal business or a sole proprietorship business. So we have what we call appropriation of profits when it comes to partnerships. That is when we look at aspects to do with the partners. So as we can see here, one of the aspects to do with the partners is the partnership salary. And we can see that the partnership salary is deducted from the profits first. And that's why we are saying 26,000 minus 20,000, which leaves us with the 6,000. So it is from the $6,000 that we go ahead to share in the ratio of 2:1. All we know that when we are dealing with ratios, the first thing we have to do is first find the total ratio. Total ratio is 2 plus 1, which gives us a 3. And then once we have the 3, it means that Bill, who is sharing 2, means that it will be 2 out of 3 times what we are sharing. It will be the total ratio, 2 plus 1, which we get as 3. Now, if you are getting a portion for Bill, it will basically 2 divided by 3 times what we are sharing, the profits to be shared. The same thing we also do for Ben, which is 1/3 times the profits, giving you what basically Ben takes home. At the end of the day, what Ben takes home plus what Bill takes home should add back to your original profit, because you're just ideally sharing that profit. So that is just what they just want to demonstrate right here. This is just demonstrating. So these are just examples that you can actually get. So maybe this is also just for your understanding. I know we looked at this when it came to business entities. The examiner could ask you about the advantages and disadvantages of trading as a partnership. Now, like we've seen that advantages, if you're running a partnership, you're more than one person. So one, you're combining skills, you're combining expertise. Two, there's shared risk. It's not one person who is running this whole thing. So there's shared risk. There's also improved decision making, because one or two heads are better than one. You also have partnerships are also not taxed directly. Partnerships are not taxed like corporate entities. Partnerships are taxed, the partners are taxed individually. After they have shared their profits, the partners are taxed individually. And if you understand the dynamics of tax, if a person is being taxed individually, then they benefit from a threshold. URA provides a threshold to people that are being taxed individually, compared to entities that are taxed a flat rate of 30%. So partners do benefit from that. So there are several benefits that you could look at, but also disadvantages definitely come into there, or aspects of, let's say, maybe you have delays in decision making because all partners have to be consulted. You have maybe cases of where maybe you're not aspects of, you cannot raise capital like a public limited company. Now, one of the things that I usually tell you, that when you're looking at either advantages or disadvantages of either partnerships, or you're looking at advantages of sole proprietorships, the much easiest way for you to either get advantages or disadvantages is to think about the other alternative business entities. Now, when I'm looking at advantages, I'm looking at partnerships vis-a-vis, let's say, sole proprietorship. If I'm looking at maybe disadvantages, I'm still looking at partnerships vis-a-vis sole proprietorship. What exactly happens? So as you can see here, as they are provided us in the text. So here they're telling us partnerships versus sole traders. We can see risks are spread since it's many people that are dealing with the business together. Then we have access to wider contacts. Definitely, every partner comes with contacts, skills combined together, more capital contributed, more access to finances, especially banks, because both of you, one of you could have security, another one could have credibility, and even the bank would feel more secure lending money to one or more people, that lending money to more than one person, because the risk is actually spread. And then disadvantages, as we can see here, they're looking at aspects of, well, as the risk is spread, okay, it means that even the profits are spread. Somebody will not enjoy their profits as it was for sole proprietor, because the profits have to be shared between among the partners. And then also when it comes to controls, the more you bring in partners into your business, the more you lose control, because decision-making now has to be in consultation of other people. And then also cases of disputes, which are not common in sole proprietor, because you're the only person who is heading this business. When it comes to decisions, you make your decision and it's final. When it comes to partnerships, one person makes a decision and this decision is not in favor of other people, and that creates disputes among the partners. So that could be one of the things that you need to look at as well. So we also have cases where we're now looking at partnerships versus limited liability companies and see what exactly are some of the benefits. So you can easily try to read this and see how to basically apply. But like I told you, one of the advantages is around tax. Corporate entities are taxed differently compared to the partnerships. Aspects also to do with starting, by the way, starting, let's say, public limited companies takes you a lot of time, because you have to issue a prospectus, you have to go through a lot of processes, many legal requirements, compared if it was a partnership. So that could also be one of the things that you could look at when you're comparing a partnership versus a limited liability companies, and so on. So preparing partnership accounts. Now, like I said, we have what we call partnership accounts specifically that relate to partnerships, okay? Now, so we know how to just distinguish between our accounting for partnerships and how that differs from that of a sole trader, okay? Now, just like the way I said, the differences are not going to be very many, because partnerships also have assets, okay? So it means that when it comes to the balance sheet, you have your assets the way they would be for any other business. It's apart from capital. When it comes to capital, for partners, we list the individual capital for each of the partners. So we shall have partner A, partner B, which list their capitals in the balance sheet, which is our statement of financial position. And the same thing we also do when it comes to current account. Now we have what we call a current account. We are going to see how that clearly comes in when it comes to partnerships, but that is very important for us. We also need to understand that also when it comes to partnerships, net profit is calculated the same way. But the only difference now comes in when we are going to do the appropriation, or where, let's say, we have a partner who makes a loan to the business. Now, as partners contribute capital to the business, they may also choose to contribute certain amounts of money more as loans rather than as capital. Now, in this case, we call it a partner's loan to the business, okay? We call it partner's loan to the business. And this loan usually comes also with an interest, okay? We also comes in with an aspect of interest. And definitely, of course, this interest is an expense to the partnership, okay, which would ideally be included within our expenses. So we are going to see how that exactly comes in and see how we can be able to link the two things, okay? Yeah, so like I said, the appropriation, and then also showing partners for showing capital for each partners. That is one of the things that we look at. So we call it appropriation of profits, which is the sharing of the profits in accordance with the partnership agreement. Okay, so partners contribute capital. And this is what we're trying to mean by funds employed. The initial capital contribution is recorded in what we call the capital accounts for each of the partners. So when you're drawing up your capital account, the capital account has columns, okay? The capital account has columns of each of your partners. So let me just try to demonstrate something here, so we can see. So if, for example, this was our capital account, so I'll just call this my capital account. So the normal capital account definitely would have aspects of our debt, our detail, and then would have amount. Okay, would have amount. That is what we have when it comes to the normal capital account, let's say for sole proprietor, and it will be this side, and it will also be this side. Now, when it comes to a capital account for a partnership, let's say partnership ABC, we are going to have a column for A. We're going to have a column for B. Let's say A is here, B is here, and then a column for C. And that is the same thing that we also shall have for the other. Now, so you know very well that when it comes to, of course, when it comes to capital, capital has a normal credit balance, and that does not change even when we are dealing with the capital accounts here. Capital continues to have a credit balance. So it means that if you have such cases, then it means that what we shall basically do have is when you come here, let's say the partners have started business on 1st January 2022. Now, these partners might contribute money through cash. So we shall write cash. So I'll just remove this column because now the partners will have their amounts on individual columns. So partner A can contribute, let's say 1,000. These are dollars, so we can have 1,000. Another partner can contribute 2,500, and maybe another partner can contribute 500. So that is how the partnership account will look like. You'll be able to see each of them with their own column as per se within our capital account. So that is what we are trying to mean here, that capital, each partner has their own column, okay? Each partner has their own column. So we have to make sure that we track how much they have contributed through the whole period. Are we together? Yes. So like we said that the capital account still remains one with a credit balance. So it usually has a balance brought forward that is a credit, okay? And definitely, of course, this is transferred to the balance sheet, okay? Transferred to the trial balance and transferred finally to the balance sheet. And basically depicts what we have as the contributions by the partners. So we have something that is new here, which is very unique to only partnerships. So we have what we call the current account. We have what we call the current account. Now, partners can choose to have their capital account either a fixed or a floating. We have what we call a fixed capital account, and then we have a floating capital account. Now, a fixed capital account means that we have the capital account. We only record aspects to do with capital contributions in the capital account, and that is all, okay? Faith, make sure you don't move either your mouse because it distracts the class. I'll just try to share. Okay, so we usually have the capital account, and then we also usually have the current account. That is if we have what we call a fixed capital account. So like I said, we have a fixed capital account, and you can note that down. And then we also have a floating capital account. So we can have that. So if it's a fixed capital account, we will have a capital account and we'll also have a current account. And if it's a floating capital account, what we usually have is we'll only have a capital account. Now, you're going to see from the aspects that go in the current account. Now, as partners contribute capital to the business, which we record as their capital here, partners also have benefits that they get from the partnership throughout the period. They also have other transactions that they deal with the partnership. And as we saw, we have aspects of, let's say, interest on drawings. So partners can take drawings, but can also have interest on drawings. We can also have loans from partners. And this also comes with interest on the loans, on the partner loan. We can also have, of course, profits, the annual profits from the partnership. Remember, we also have things like salaries. So all these are, some of them are benefits, some of them is the partner that is making the payment, but they are basically throughout the running of the partnership. Now, these records are mostly recorded or are supposed to be recorded in the capital account, because the capital account represents our relationship, the relationship between the partner and the business. But some partners may say that we want to run our capital account like one for sole proprietor, not changed at all. If we contributed, this is the capital we contributed, and that should be our capital account. Then they decide to have something that is very similar, but this time they call it a current account. So they will just have a current account to record the rest of the transactions. Any other transactions that relates to them and the partnership is now recorded in the current account. And that's why in that case, we call it a fixed capital account, because this account will not change until maybe a partner contributes money. So there will be nothing else that will be posted in this account. But when it comes to, and that is when you are dealing with a fixed. Now, when it comes to a floating, we don't have the current account. So it means that all these items that I've listed here are actually recorded, are mixed up with even the capital that was contributed by the partners. So everything is recorded in a single account called a capital account. So that is when we have the capital and the current account. That is only when it is the fixed. So there is also what we call a withdrawals account. We shall just see what that basically means. But for now, let's take it that a current account, as here they're saying it records profit retained in the business by the partner. We shall also see that it records even more other items. Now, a current account just behaves like a capital account. Current accounts also have a normal credit balance. So it is sort of a capital account as the text brings it, okay? So we are going to see how that works. So it increases in value when partners make profits, but also falls in value when partners do what? When the partners, let's say, have drawings, okay? And we're going to see more when we look at how that exactly looks like. And then, of course, the drawings account, like I said, that these partners can also take drawings. So we also will see how the drawings also come into play. Now, one of the things that I could just demonstrate here within our current account. Now, they are telling us that the key importance of our current account is to record profits. So in case our partners at the end of the year, maybe 31st December, they made some profits and then they shared those profits. Okay, they shared those profits, and maybe this one got 200, this one got 500, and maybe this one got 100. The profits will be recorded on the credit side because ideally this account has a normal credit balance. When partners make profits, this account is benefiting. So this account is credited every time the partners are benefiting, and it is debited when the partners are not benefiting. That's why I'm saying they credit it when the partner's value is increasing and when it's reducing. So in case we have drawings, let's say partner A took drawings maybe through the period. Maybe this was 1st of March 2022. So if we have drawings, then those will be recorded on the debit side. Maybe drawings of, maybe let me say 2000. Let me record it like that. So that is what happens. And that's what we are trying to actually relate here when they are telling us that the drawings account serves exactly as a purpose for the sole trader. And each partner's drawings are recorded in a separate account. At the end of the accounting period, this is how we record our drawings. We debit our current account, as you've seen me putting that value on the debit. As you debit, you're crediting your drawings account. So that is how the double entry would come in when we are looking at that scenario. Okay. So I also want to comment on loans by partners. Like I said, partners, instead of contributing capital, they can also give us loans. And these loans are supposed to be paid later back. But before even they are paid back, we usually have interest on them. So the partner is like a bank. You have given us a loan and we have to pay them back interest on an annual basis. So a partner's loan or a loan by a partner, just like any other loan, it's recorded within our liabilities. And this could be a long-term liability, especially if it's repayable in a period that is above 12 months. But then also, for us to note that the interest is credited to the partner's current account. Why? Because in this case, the partner is benefiting. We are paying this interest to the partner. The partner is benefiting. So when you come to your current account, interest on the partner, if let's say interest on the loan, interest on loan is recorded on the credit side here. Let's say maybe we had a loan of 1 million and the interest is, let's say, maybe 1% or 10%. You'll be able to record it here. Let's say maybe it is B that gave us a loan. And let's say the interest calculated is, let's say, maybe $1,000. So it will be recorded there. Why it is being recorded here? Because the partner is benefiting. The partner is charging the partnership interest for giving us that loan. So they are benefiting. That's why we credit, just like the way we created the profit. So that is what we are trying to mean in this text. The loan by the partners. Of course, when you go to the balance sheet, our statement of financial position, we also take it under liabilities. But this is just for demonstration when it comes to preparation of our current account. Okay. So the loan from the partners, we can see, is accounted for in the income statement, not the appropriation of profits. Now we are going to see what we mean by appropriation of profits. We are going to see what we mean by appropriation of profits. So like we said, appropriation of profits happens after we have determined the net profit, the general net profit. Okay, the general net profit. And what I mean by that is we know very well, and one of the things like I indicated, I said partnerships are not in any way different from our normal financial statements that we've been drawing. The only difference comes when we are doing the appropriation. Now, this is what we are saying. If, for example, these guys are ABC partnership, and this is, let's say, their statement of, let's say, profit and loss. Profit or loss. Maybe this is for the period ended 31st December 2022. So you know very well, if they are dealing into sales, they'll have their sales. They'll have, in case they have sales returns, they'll have them. Let's say maybe this is what they have. Then they'll have their net sales. In the same way, here nothing is coming in when it comes to aspects of partnerships, okay? So net sales there, they still move to less cost of sales, just like the way we have for any other business. So here we have opening stock, and we have ad purchases, then less closing stock. So you're able to get your so-called cost of sales. So cost of sales is right here. And then you get down to your gross profit, just like the way we do the same thing. And that's why the format is not changing in any way. So you get your gross profit right there. Then after that, you less your expenses. Normal expenses, even partnerships have salaries. They have salaries, they have rent, they have electricity, and so on. So you have all these expenses coming through. Now, one of the things they are also telling us that when it comes to the interest on loans, it is recorded right here. The interest on loans is recorded right here. And this is the partner loan. This is the partner loan. It is recorded right here. And we are going to see why they are trying to emphasize so, okay? So after you have done all this, definitely you have your total expenses. Right there. And you have your net profit or loss. Now, in the same way, partnerships can all either make profits or they can make losses. And in all cases, the profits or losses are shared by the partners. So after you have determined your profit and loss right there, you now come and do what they are calling the appropriation of net profit. So you have now appropriation of net profits. Now that is when you now start to look at other areas that relate to the partner, the partners that you have at hand, okay? That is what you come to now. We now going to look at aspects of, do we have any debit entries? Do we have any credit entries? So maybe just to get back to this screen again. So they're telling us that, of course, we share, appropriation is more of sharing profits. So they're giving us some accounting entries here. They're telling us that we have cases where we debit our income and expense account with a net profit. Of course, we see the net profit that we have gotten and then credit our appropriation account. Now, sometimes, again, sometimes the appropriation account can also be drawn as a T account, just like the way you see how we have our current account, okay? Just like the way we have our current account that we have drawn here, you can have your appropriation account drawn like this. That's why they are calling a debit and credit, okay? You can have your appropriation account drawn like that. Though in this has changed over time. We usually have one that is in a T in basically in a vertical format, okay? We usually have one that is basically in a vertical format. So we first transfer the profit to the appropriation account, and then from the appropriation account, we transfer it to the current account. So whatever we do in the appropriation account, we shall later transfer it in the current account for each of the partners. So these are the steps to follow. So establish how much profit, net profit is. So as you can see, we have established how much profit is, this one. So this is our step one. We have done the step one for our appropriation account. The next thing they are telling us here is appropriate interest on capital and salaries first. Both of these items are an appropriation of profits and not expenses to the income statement. Now, I want you to listen very critically here. Interest on capital is a reward to partners for contributing capital. It's not the interest on loan that we saw above. And salaries, these are partner salaries. So what we are being told here, that these should never be included as part of your expenses. So you should never put a partner salary under your expenses, or you should never put interest on loan under expenses, but rather first find your profit there and now come to the appropriation. And when you get to the appropriation, what we are basically doing is we first remove the interest on capital and salaries. By them saying appropriate means we have to remove them. So we shall now bring in here and say less interest on capital. So in case there's interest on capital, we'll have that value right there. And then the other one, we are lessing as salaries to partners. Now, you need to understand that there are other salaries that relate to the rest of the employees. Now, those ones are under your expenses. It is only the partners' salaries that come under appropriation of net profit. So that is very important. So that is the second step we have done, to appropriate our interest on capital and salary first. And then if at all there is what we call interest on drawings. If there are interest on drawings, then we also recognize them in the appropriation account. Now, interest on drawings, like we said, partners can draw money from the business. Partners can remove money from the business for their personal use. Now, not to encourage partners to continue removing money from the business for personal use, we usually have what we call interest on drawings. So that is made, put up just not to encourage partners to remove money from the business. So partners, if we are trying to look at this, we debit our current account and credit our appropriation account. So crediting our appropriation account means, since we are looking at an addition here, because this is, remember, this is now in a vertical format. So by crediting. Appropriation of profit, of net profits, also has a normal credit balance if it's in a T format. If it's in a vertical format here, we are going to add our interest on drawings. Why we are adding our interest on drawings is because this is a benefit. This is in addition to the net profit. These amounts are a benefit to the partners that is yet to be shared, because the partners themselves who have drawn money bring in money back with interest, and this interest is in addition to what is to be shared. So that is why we bring it here. So what they are telling us also is that in case you also have it, you're supposed to come and debit your current account. Now, the reason why we debit the current account here is because if partner C took a drawing and now they are paying interest on drawing, this is not in their favor. And anything that is not in the favor of the partners, let's say any reduction in the portfolio of partners within the partnership, is always credited. So in case we had interest on drawings, maybe it is partner C that had an interest on drawing, maybe it's maybe 100, we shall record it right there on the debit side, okay? So that is very important. So here we are crediting it, but here we're now, since this is a vertical format, we can just demonstrate it by adding our drawings right there. So that is what we have. And then once we have this, one of the things that we also need to look at here is, let's just see the next step. So we have looked at the interest on drawings. Now, after that, we get the residual profits. We get the residual profits. We get the residual profits. So the residual profits is basically what appears here. After you have gotten this net profit, less your so-called interest on capital, less your so-called partner salaries, and add back interest on drawings, this gives you what we call residual profits. It can also be losses, but it basically gives you your residual profits. Now, these residual profits are the ones that we are going to share. So, as we can see, this is now, because they're telling us that residual profits, this is the difference between the net profit plus interest charged on drawings and appropriation on interest on capital and salaries. So that's what we have gotten. And this is shared among the partners based on their profit sharing ratio. Now, for examination purposes, the examiner will always give you the profit sharing ratio. But in practical, when you're working for a partner business, this sharing ratio will always be in the partnership deed. You can always look for the partnership deed or the partnership agreement and be able to find this information. The examiner can also sit and ask you, explain the content, the different elements that are listed in the partnership deed. So profit sharing ratio is one of them. Partner salary is one of them. How to admit a new partner, guidelines on that is one of them. Exit of a new partner, what exactly happens, all that will be there. So partnership deed will have everything that relates to how partners work. So that is very important. Now, sharing of profits. So after we have our so-called residual profits there, we shall now share profits. Share of profits. So we'll have partner A, we'll have partner B, we'll have partner C. And like we said, for example, if I told this was maybe 2,500 being shared, and let's say this was being shared on a ratio of 2 to 1 to 3 2 to 1 to 3, our total ratio here gives us a 6. So it means that A will get 2 divided by 6. Sorry, this one will not give me, let me just try to do the 2 divided by 6. Let me remove this and make it general. Sorry for my formulas here. But 2 divided by 6 will be like that. It's actually 0.333. And then B, it is 1 divided by 6, which is that. And then 3 divided by 6, which gives us 3 divided by 6, 0.5. Okay. So this, you can even go ahead to multiply directly with the profit that we are sharing, times 2, 500, times 2, 500, times 2, 500. So this gives us, so at the end of the day, when you add up all this, it will definitely come to 2,500, but now it has been distributed among the partners. As you can see, C got more because according to their ratio, they are getting 3 out of 6. So that's why this is like this. So this is the appropriation of. So whenever somebody says appropriation of profits, they are speaking about this. This is what they are speaking about. They are speaking about this part. And this is the difference between your normal P&L and the P&L for partnerships. You'll do exactly everything the way it is, just even for depreciation. You'll do depreciation, you put it there the normal way. And the only difference will now come to when you come to the appropriation of profits. So that is what we have to understand there. Now, after you have gotten these amounts, maybe also just comment on this. After you have gotten this share of profits, these are the amounts that you now transfer to the current account. So we saw that the current account has profit shared, the profit share. So just in case we're just transferring these values, we just transfer them as we have gotten them. You bring them here. I'll first put them here. So this will be here, this will be here, and this will be here. Sorry. This will be here. So that is what we have within our current account. So that's what they basically mean when they say you now transfer the values into the current account. Okay. So that is very important for us to pick. And they're telling us the balance on the partner's drawing account is debited to his current account. So we also saw that when it came to the drawings, we already brought a drawing here. In case we had drawings, that's what they are trying to mean, how we debit our account. Okay. Guaranteed minimum profit share. So the partnership agreement may provide that one partner has a guaranteed minimum profit share. This is not very common, but it can happen. Maybe that partner is the one that contributed capital to the business, and they dictate that they will always have a minimum profit share despite the current profit sharing ratio or despite the amount of profit that the business has earned. Okay, so whenever we have such cases, then we have to first mind about that partner and then go ahead to share the profits. Now, this is not something very common to find in the exam, but just in case you want to read more, you can actually find it. You can just try to look at this example. Okay. Yeah. So let's just see an example of partnership accounts and see how that basically appears. Okay. So we have an example here. As we can see, this example going up to down, we can just try to see how it looks like. So they are telling us that Loki, Nancy, and Monster are in partnership with an agreement to share profits 3 to 2 to 1. They also agree to the following terms. So they are saying that all the 3 should receive interest at 12% on capital. Monster should receive a salary of 6,000 per annum. Interest will be charged on drawings at a rate of 5%, and this is charged on the end of year drawings balances. The interest rate on the loan by Loki is 5%. The statement of financial position as at 31st December 2015 reveals the following. So we can see capital accounts. Loki has 20,000, Nisi has 8,000, Monster has 6,000, which totals to 34,000. And then we can also see on the current accounts that Loki has 3,500, Nancy has 700 in bracket, which is a negative, and Monster has 1,800. Now, I want to comment on this before I proceed. The current accounts, we've said, behave just like the way the capital accounts do behave. In this case, these partners run what we call a fixed capital account. So whatever you're seeing as the 20,000, 8,000, 6,000, these are the capital contributions, and that is all. So anything else that is between them and the partnership is recorded in the current account. That is why you can see that Nancy is even in negative. Now, if you remember how our current account looked like here. So you can see that there are cases when you balance off this account and this account gives you a debit balance. Now, a current account ideally should have a normal credit balance, but there are cases where this account can have a debit balance. And those cases come in when a given partner, a case in example, partner A. In case partner A, when you compare what they got in terms of profit share vis-a-vis what they have either taken out of the business or interest on drawings and so on, if you see that it is more on this side, like we are saying 2,000 on this side, because we are saying 2,000 is on this side, and this other side, it is 8.33. In this case, you have a balance. Your balance brought down, balance carried down will be here, balance brought down will be on this side. So this balance brought down will be recorded as a negative. When you're trying to present it on your statement of financial position, this value will be in a negative because it shows that this partner overdrew his account. Means that whatever they took out of the business exceeds what rewards they got from the business, what rewards they have gotten from the business. So that is what exactly happens. So that's why you're seeing such things happening. So you can see that partner B only has items on the credit side and they have nothing on the debit side. So this partner will have a debit, basically a positive balance, because their balance will still be a credit balance, which is in line with the normal account balance for a current account. So that is why we are seeing that value being provided in negative. And that's why they're giving us a capital account and a current account. And they have also told us that loan account, Loki. Now remember, Loki gave us a loan. Interest loan by Loki is 5%. So the loan is 6,000. So capital employed to finance long-term assets, they're just trying to add these values, adding equity plus long-term liabilities to become to that. Then they also come down here and they tell us that drawings that were made during there to 31st December 2016 were as follows. So we have 6,000, we have 4,000, and we have 7,000. And then they are telling us that the net profit for there at 31st December 2016 was 24,530 before deducting loan interest. So they are telling us required prepare appropriation account for the year to 31st December 2016 and the partner's capital account and current account. So this is our question at hand. Now, as you can see in this question, they have not asked us to draw the P and L. So some questions can ask you to draw the P and L, but remember, if you remember our steps for preparing appropriation account, the first step was to determine our profit. The first step was to determine our profit. So ideally, even if they have not talked about us preparing a profit and loss, we have to first determine our so-called profit before we appropriate the profits to the partners. So that is one thing that we have to consider. So we are going to do this very fast and see how it can come out. And it should be very simple because we already know what to do. And we can be able to relate information even with our understanding of how the profit and loss looks like, okay? So I'm just going to do this on my Excel here. Okay. So our partners is Lucky, Munsi, Monster, and Mincy. So it means that the first thing that I'm going to look at, like I said, I have to first actually go ahead to calculate the profit for the period. Okay, I have to calculate the profit for the period. So I'm first going to draw up their P and L and then determine the profit, the net profit. So I'll just come here, say Nunsi, Muki, Nisi, and Musta. They want the appropriation account, okay? But like I said, for us to find the appropriation account, we have to first calculate the so-called profit. Now let's see if they have given us the net profit from our question. Let's just see if they have given us our profit. Sorry. So back to our question here. Let's see from this information if they have given us our profits. So they share the profits, profits to the ratio of that. They have given us interest on capital. They have given us the salary. interest on drawings. They have given us the statement of financial position here. Now the net profit is actually here. So we actually have the net profit. So we don't have to basically calculate it. We already have it. So in this case, they have helped us. Now, most examination questions, especially for financial accounting, you'll get to realize that the examiner will give you a trial balance and will give you information that you have to use to calculate this net profit. But since they have given us the net profit, so here we shall do this directly, okay? So I'll just come here and say net profit. This is net profit for the period. Okay. So if that is what we are saying, let me just add this to my heading. So it is for their ended 31st December 2016. So the net profit is that. So once we have a net profit, you remember our different steps, the ones that they gave us here, the steps that we just looked at. I'll just show you something. Right here. So these were the steps for determining the approbation of net profit. They told us the first thing is to determine the net profit, which we have. Then they are telling us the next thing is to appropriate or less the interest on capital and salaries first. So the next thing I'm going to look into my question is to look for interest on capital and salaries to make sure that I'm actually taking into consideration. Now, they have told me that all the three should charge interest on capital at 12%. This 12% is supposed to be on the 20,000, on the 8,000, on the 6,000, because this is their capital. So interest is on capital. Are we together? So that is what I'm going to basically do. So I'm going to now do my interest on capital. So my interest payable. So what I'll do, you can calculate this aside, okay? You can have working. Since we are going to calculate, so interest payable. So we have our partners. You just list the partners the way they are. Lucky, Monster, Nins, and Monster. So this is partner. This is capital. This is their interest on capital. Okay. So we saw that from the information we've been given, the different capital balances that we have for each of them. Lucky has 6,000. Lucky has 6,000. So I'll just put 6,000 here. Nancy has 4,000. And then Monster has 7,000. So I'm going to now interest. They have told us, they have given us interest on capital to be at 12% for all of them. So interest will be 12% times this. So to give me 720. For NIS, it will give me 12% of 4,000 gives me that, then that. So that is what I basically have at hand, okay? Did I use the right figures? Okay. So we now see our different capital balances, and then we are trying to get what you would call your respective interest on capital, which we have gotten there. And as you can see, if you add this together, this gives you this is 720, and this gives you about 480, 840, gives you that. Okay, so let's again try to look at what we have. So we also have a case of where Monster is receiving a salary. So they told us that salary and interest on capital should be removed first, okay? So we have determined the interest on capital based on these values. Just confirm that that's what we have here. So this, sorry, this was, I think I copied the wrong figure. This is 20,000. I think I picked different figures. $8,000 and $6,000. 8,000. I think I picked different figures, but ideally we should pick the interest, the capital balance. If we are calculating interest payable on capital. So these are the values that we have gotten. Now we look at the salary and we should be good to go. So I'll just come here and say less interest on capital. So interest on capital is this. So I'll just copy the names. And put the values there. You can even do this. So I'll just put them here, and then the total will be here. Okay, that is what I basically do have at hand. So after that, now I'm going to remove the salaries, and they have told us that it is Monster that receives a salary. Okay, so I'm going to come and remove Monster's salary. So from what we've been given, Monster earns a salary of, let's try to check, a salary of 6,000, okay? A salary of 6,000 per annum. That is what Monster earns. So I'll just bring it there as well. So all these items are being less. This is being less. This is also being less. I also just put it as a negative. Just for uniformity. So that is the first. That is first thing that we're doing. That's actually that is our second step. That is our second step. And I just want to follow this our steps so that we can be able to pick this and be able to even try out the rest of the other questions. So the first step, net profit was given to us. Then we have appropriated this. And as we do that, they are telling us we also do take it to the our current account. Now, from this question, they have asked us also to draw the current account. So it would be very important for us to actually do the current account as well, concurrently, because one of the things that I usually tell my students is that actually they're asking us for the partner accounts and the current accounts. What I usually encourage you is the time management. Just make sure that once you finish one thing, you should be able to finish the other to go. So I'm just going to pick this and I use this. Just pick it, this. So you make sure that on your paper, you leave some space and put up your capital account. Now I'm going to remove this information. So this capital account, this time it's for Lucy Monster. So I'll just pick the same heading here. I'm using my Excel, but or you should be able to use your pen as you note this. It means that the first column here will be for Lucky. The second column will be for Nancy. And then the other column will be for Monster. Okay. I have an extra column here. Let me do this. So that is what I have. Basically, I'm going to do this. So this is their capital account. Okay. And this is okay. Let me also do a very similar thing, but this time it's going to be a current account. Like I said, these two documents look the same, just a few differences. So this will also be the current account. So I've done that. So somebody's asking here, aren't we supposed to deduct the loan interest from the net profit before appropriation? The question says net profit is given before deducting the loan interest. Okay, I'm going to comment on that. Let's just first finish this. So let's imagine this is our current accounts, and this is our capital account, okay? Now, from what we have here, let me first fill these accounts, then I'll respond to the question. We have our capital account. We have these balances. So you transfer these balances to the capital account on the credit side. These will be your balances brought down here. So I'll just first put it here. So capital has a normal credit balance, so it will be there. Then 8,000 will be here. And then 6,000 will be here. Okay, that is what we have. Then the current account still has a normal credit balance. I also pick the balances. Okay. Can just copy it. Now, this one that has a negative balance, okay, the balance is put on the debit side. So just let me just record here. This is, remember, these balances are as of end of last year, 2015, okay? So they are the same balances as of 1st Jan 2015. Okay, 2016, sorry. As they are end of balance, the other side, they are the same thing here. So that is balance brought down. The same thing also we have here. This is a balance brought down. So Loki has 3,500. Now Nis has 700. Now what we shall record for, we shall also have a balances here. And the 700, this 700 of Nis will be here. For it is a debit balance. That's why we record it there on the debit side. Then Monster will have a positive balance this side, like that. So I just recorded it here so that we can follow this properly. So there was a question on interest on the loan. So we have interest on the loan given by Loki, which is at 5%. Okay. And they are telling us this loan is worthy 6,000. And they're also telling us when they are giving us the profit, let's see the profit. So the profit is before deducting the loan interest. Now, I just want to draw your attention just a little here. So that we can understand it together. So they're telling us that if a partner makes a loan to the business, he will receive interest in the normal way. Loan interest due. Interest on capital partners are deducted and the remaining net profit is apportioned according to the profit sharing ratio. So here we have our so-called loan on interest. They also provided us loan by partners here. So they told us something here again that we need to also take into consideration. They're telling us that interest on loans from partners is accounted for as an expense in the income statement, not in the appropriation of profits. And I explained what that means. So if they're telling us that we didn't deduct, there is an interest on loan that wasn't deducted before this profit, then it means that we have to deduct it before even appropriate. Okay, so what we shall just do here, since I have Excel, since I'm using Excel, I'll make the adjustments. Thanks, whoever has picked that up. So what I'm going to basically do here, I'm going first less, because this profit is not for the period. Okay, this is before interest on loan. So let's first remove the interest on loan. So it is 6,000, and the percentage we have is, the percentage we have, just trying to check my the question, is 5%. Is 5%. So we shall just try to do this. This is 5% times 6,000. So we're getting about we are getting 300. So it is $300, which is our interest. So we are first removing it from our profits before we can appropriate them. Okay, so that's important. And maybe you can okay, since this is already an appropriation account, you can just say this appropriation of profits. Okay. Or let's call it profits to be appropriated. So when you get this minus this, gives you this value. I'll then record it here. This is negative. Okay, since I've already made a negative, so it's that 24 to 30. Okay. So we have our interest on loan, which we have gotten right there. We have less, we have monster salary. Okay. Now let's just follow through our guideline again and see what we have to do next. Now they told us that after we have less the salaries and so on, we have to go ahead to remove, in case they are drawings, okay? They're telling us something here. If partners agree to pay interest on drawings during the year, this is what we do. We debit our current account and credit our appropriation account. So what I'm going to basically do, because in this case we have that case, we have the drawings. Right here, just a moment. So partners charge drawings at the 5%. Let's see if these guys have drawings. I think they do. Yes, they're telling us the drawings made in there were as follows. So if these are the drawings that were made in there, then we have to calculate the interest on drawings for each of these partners, okay? And we have a percentage, which is 5%. So what we do here, I'll just come here. I can also do a working, and I say interest payable on drawings, and say these are the drawings. These are the drawings. Then interest on drawings. So they have given us a percentage of 5%. So 5% times 6,000 gets me that value like that. And this will give me a total of that of 850. So that is what I have. So now I'm going to go ahead to take it in my what? In my appropriation account. And these have to be now interest on drawing is added back. Okay. Interest on drawing is added back. Add, because it's a benefit to the partnership. Though it is a where basically deduction on the partner side, it's a benefit for them before we share the profits. Interest on drawings. So I can even come, you can either write the total there, or you can bring the whole the summary, and then we can get the total here. Okay. So this is 850 right there. 850 as our drawing. Now, they said as we put it here, we should put it in our what? In our current account. So you go to your current account. You write here, maybe this is 31st of December, 2016. Write 300, you write 200, then you write now. One of the things that you need to realize is that the examiner talked about that the drawings, the percentage, the interest is charged on the balance, the last balance. Interest will be charged on drawings charged at the end of their drawings balances. So just in case these maybe partners had taken any other extra drawings during there, then we would have to adjust them before we charge the interest. But in this case, there was no such a case, okay? Whatever we have is what the partners took, okay? Because remember, these are accounts of 2015. So, okay, drawings made during there, these are the drawings made during there. So actually 2015, there was not, we don't have any drawings, but in 2016 we have. So we have been able to charge on this. These are the closing balances, okay? So that is very, very important for us. So once we have looked at that, we have taken into consideration interest on capital. We have taken into consideration the salaries. We have taken into consideration the drawings. We have taken into consideration the interest on the loan, which is the 5%. We have recorded values in the capital account. We have also recorded values in the current account, the balances. So we have this loan. We used it in calculating the interest. That was capital employed. Now we also have the drawings. We have drawings. Now drawings will not go in your appropriation account, but they rather go into the current account. So your current account has drawings in them. So this current account that we are seeing here has to record those drawings that are taken. As the other account has only looked at interest, the current account here has to also look at these drawings recorded there, okay? So that is very important. So what I'm going to basically do, as you can see here, I'm just going to come here, use the same date. I said drawings, and pick them the way they are. These ones, this time I'm first recording the drawings. This, okay. Not forget, I think this was interest on drawings. This is interest on drawings. So as we can see, the interest on drawings and drawings all appear on the same side of the current account. Though we know that the interest in drawings, the alternative account here, the double entry is completed in the appropriation account. Well, for the drawings here, this is completed in the drawings account for the partners, which we also maintain, okay? That is important for us. So after we have recorded our drawings, because they didn't ask us to draw up our drawings account. So if they had asked, maybe would basically go ahead to record it. One of the other things that also goes to our current account here, of course, we have the balance brought down that we are seeing here that already we already recorded. But just in case, we saw one of the things that we saw was when we came here, there is interest on loan. And one of the person that gave us the loan is Loki. Sorry, this is not, the interest on loan is here. This interest on loan by Loki of 300, as it is recorded in the appropriation account here, it also goes in the current account. Also goes in the current account and recorded under Loki on the credit side, because Loki is benefiting from this transaction. So his account is credited. That is one of the other things that we also look at. Now, just like also when it comes to interest on capital. Interest on capital, because we're doing this concurrently. This so-called interest on capital that we list here, okay, is supposed to be recorded in the current account on the credit side, because the partners are also again benefiting, okay? As we list it here to adjust our profits, when it comes to the current account, it is credited because the partners are benefiting. So I'll first record it here. So we'll have something like that, okay? That is one thing that goes. Now, as we can see, our capital account remains untouchable because it's more of a fixed capital account. Our capital account continues to only have items that we posted there. Remember what went in the capital account was only the balance brought down. What would only change if at all the partners had contributed any other capital. What we have left out here is the salary. The salary also goes in the what? In a current account, 6,000, because the partners are benefiting. So just come to the here and say Monster salary. Monster is the one getting, this is 6,000. So you can see anything that benefits the partner, this side, anything that is being charged onto them, either drawing, either interest on drawing, is being recorded on this other side, okay? Now, if we have expirated on whatever enters this account and whatever enters the capital account, then we have to now determine our residual profits, okay? We have to determine our residual profits, and that is on assumption that we have recorded everything that needs to go into our appropriation account, okay? If we are sure that we have recorded everything, then we can do our share of profits. So let's just calculate this. Let's come here. Say residual profits. Can also be losses. So remember, we had the profits to be appropriated, so they are being deducted by this. So I'll just put it there. So it will be this. Remember, we are lessing the interest on capital raised as a negative, so I'll just add. And also Monster salary, just also add. This is already negative. Then we also have the 850. So that gives us $15,000 to be shared, okay? That gives us $15,000 to be shared. Now, these $15,000, we share them according to the share ratio that they gave us. Now, as part of the exam, like I said, the examiner will always give you the sharing ratio. So even for this, they also gave us a sharing ratio, which was 3 to 2 to 1. So that is the sharing ratio we do, and it's in this order, 3 to 2 to 1. So I'll do the same thing here. Now here I'll list the partners. I'll first put this here. So it is this. So if this is the residual profits, means that this so-called Loki will get 3 out of 6 times 15,000. Nins will get 2 divided by 6 times 15,000. And this one will get 1 over 6 times 15,000. So you just calculate them there, and yeah, should be able to get the answers. So when you add this profit shared, it will still take you to 15,000 because you're definitely sharing the same profit. So that is how our profit will be shared among the partners. Okay, that is how our profit will be shared among the partners. So once we have shared our profits, these are transferred to the current account. You just come here. These were the same dates. The same date. It's a profit share. Just bring those values as they have got, as you've gotten them. Sorry, recording the wrong path. So this is here. This is here. And this is here. So like that, that is what we have. So after you have done that, you now close off balance of your current account. So what we shall have is we can add this side. You know, this has a normal credit balance. So ideally, the first thing we shall try to do is first add the balances on each side. And then see what we exactly get this other side. Okay. And you can see this side is higher for every item. This is higher, this is higher, this is higher. So it means that we shall have same debt, shall have balance carried down. This will be the 13,700 minus 6,300. Oh, this will be 5,960 minus 4,900. Normal balancing off basically. 11,020 minus 7,350. So the totals will now be the same. And as these are balance carried down, there also be your balance brought down. It should be your balance brought down right there. So friends, that is how we would approach that question. And I do hope that you've gotten something from today. And in case you have any question now, this question didn't ask us to redraw our statement of financial position, but just asked us to redraw the statement of financial position. These will be the values that we take in our current account balance, the one that we shall show in our statement of financial position. You also come up and close off your capital account. Still, we shall close with the same totals here. And that is how this will be. So that is how we prepare accounts for partnership. Okay. Yeah. Look out for questions, past paper questions, and practice. The text I'm using also has some examples, more examples that you can leverage on. And then also has some exercises. If you have some time, you can actually try them out. And where you have challenges, you can keep them and ask them. You can ask them in the WhatsApp group, but you can also ask them when we meet next time. Okay. I'll be informing you on our next meet. But like I said, we want to utilize the online space to do a catch up. And I believe that my friends that are joining in from the online class, the ones that usually attend the physical class, I believe that you've been able to pick something despite the fact that you used to the physical class. Okay. Yeah, so thank you so much. Wish you all the best.